Good day, my name is Dean Crocker. I'm a senior equity analyst with the PSG Wealth research team, and today I'll be taking through our latest EIA report completed on the newly named TotalEnergies SE. So just by way of presentation, the four key components that I'd like to leave with you following this presentation. We have maintained our overweight recommendation. There is a nice key table in the next slide, which just shows you the relative valuation comparable relative to our last EIA reported. It does show that the valuation does seem a lot more attractive following those very strong results, really off the higher realized prices, which really seems quite a significant support in terms of both Brent as well as LNG prices. The group has managed to improve their balance sheet substantially. This is really largely due to the stronger free cash flow generation, and there is obviously resulting in a lower gearing ratio with a net debt to EBITDA of only 1.49 times. The group has also maintained a very stable dividend, which is very pleasing. With regards to the final point, we do see Total offering a nice oil hedge. It has historically offered some sort of correlation, or a correlation strong to that of Brent. It is weakening over time, however, it is still standing, with that optionality of renewables exposure. Now, renewables exposure is becoming a very key component of this business, particularly given that the world and a lot of the economies as well as companies have a requirement to try and reach a net zero carbon emissions roughly around about 2050. That will require that, as a nice, cheap and easy entry point is that of utilization of LNG, which has a lower carbon footprint of that of Brent. So just in terms of that key valuation table that I mentioned, you can see that this is just relative to the 14th of April 2021, which was our last recommendation date. We have maintained our overweight recommendation, and as you can cast your eye across the various table metrics, it has effectively improved across all the valuation metrics, apart from that of the dividend yield, which on a forward basis has reduced slightly. In terms of the event, it was the first half results for the full year 22. There were strong results supported by buoyant LNG and as well as Brent crude price oil. The prices were substantially higher, and there were some surprisingly positive volumes coming through as well. In terms of the metrics, Total has seen numerous once-off events over the last, call it, 2 to 3 reporting periods, resulting in lots of once-off events going through that income statement. So for this measure, we utilize the adjusted measures or metrics just to look at that income statement. In terms of adjusted EBITDA, that was up nicely 59% to 16.8 billion. Variable cost margin was lower at $7.6 per ton. And then the adjusted net income benefiting from both, increasing by 239%. On a free cash flow basis on organic investments, that improved substantially by 143% to 6.5 billion. It is worth noting that this is for the first half. So if you were to compare that to the net debt, which currently stands at 25 billion for it's a point in time reference, which is down 21%, and a net debt to EBITDA roughly 1.49 times. That free cash flow of 6.5 billion, which if you were just to annualize, assuming double, looking at roughly about 12 or 13 billion, relative to net debt of 25 billion, shows you the strength in terms of the balance sheet. It really has improved, and the net gearing has improved on the back of that. The group has maintained their quarterly dividend at 0.66 euros per share, and the offer, and has also showed a nice improvement in the break-even price, which is now standing at $25 per barrel. With regards to the impact on data release, it did close slightly higher and beat the Dow Jones relatively. In terms of the beginning of the year, Total has outperformed the benchmark, returned 3.2% above the benchmark. On a year-to-date basis, it's currently staying just below 17%. So with regards to assessment, I've touched on the various points during the presentation. We do see that at present it does seem to offer a much more attractive valuation on the back of those stronger results. There is strong price demand for LNG and Brent. LNG obviously offers a nice easy entry point for carbon neutral optionality. As I've mentioned, you'll go and look at a lot of the likes of Sasol and the other companies. They're going to use a lot of LNG in their furnaces, as it does offer a much lower carbon footprint. So that should continue to support the prices of LNG going forward. The improved variable cost margin was pleasing, and it does offer one of the lowest break-even points of $25 per barrel. In terms of the free cash flow, that remains relatively strong. It has shown nice improvement over the time, and the debt is lowest near $25 billion. It is worth noting that in terms of the dividend recommendation as well, despite COVID hitting, they continue to pay out dividends, which did show some nice strength in terms of both the balance sheet and as well as the shareholder returns for management. The group does offer that oil hedge, as I mentioned, and it does offer the renewables flavor, which should see support going forward, particularly given the carbon neutral requirements of the world. On the back of all of that, we've maintained our overweight recommendation. So if you'd like to place a trade, you're welcome to speak to either your financial advisor. Alternatively, the trading desk would be more than happy to assist. Please take note of the disclaimer and have a great day further. Thank you.